Welcome back. Today, we're going to go into what I consider to be a cheat code, one of the best option strategies you can learn, and one that's going to prove consistency for you. We're going to talk today about covered calls, how to use them, what they are, and how you could be successful using this option strategy. So, what is a covered call? A covered call is an option strategy where you're able to sell one call option against any 100 shares of an underlying stock that you own. So, you own 100 shares of Apple, you're able to sell one call option contract against those 100 shares. They're a beneficial tool for investors and traders because it could be used as potential income, it could be used as a way to mitigate risk and hedge against your long-term portfolios, or it can be used as a simple option strategy for traders on the weekly or bi-weekly way to produce income and have a successful trading career. Yeah, of course there's risk involved. Anytime you hear the word options, high fucking risk. No low risk, no medium risk, high fucking risk. Any option strategy there is. I don't give a shit what anyone says. With covered calls, the biggest risk that you face is that your underlying stock, because you have to own underlying stock to sell covered calls, that's the covered portion of it, drops significantly. So yeah, you buy in at 20, you sell a $25 covered call, the stock drops to 10. What do you do there? You find yourself in a very high risk shit situation, but I'm going to tell you there is ways out of it, and all in time, you will be profitable. The way that covered calls provide additional income to your existing stock positions is by selling that call option. So if for Apple, if you have 100 shares of Apple at 160 bucks, right? And you sell a $170 call option, someone has to pay you, a buyer in the market has to pay you for that options contract. And that pay amount, that let's just say it was a $200 contract, that $200 is yours forever. Once you sell that option and it is filled, that is a realized capital gain and you keep that 200 bucks forever. That's the additional income part. Yeah, covered calls are extremely advantageous when stocks are declining. So, like in 2022, when everything was declining, we had a full year of decline through the whole market and through almost every sector. Then covered calls would have been great because you would have been able to hedge and mitigate your risk on those losses. And when you saw the reversals coming, you could simply let your stocks go again. And you can lower your cost average while doing that, collecting small paychecks, reinvesting, keeping it as cash. There's so many benefits to that. But I find covered calls are best used for downside protection long term against your underlying stock, or just used as simple capital in and out 150 times a year, just small chipping away at stocks at 50 cents to a dollar increments at a time. This is an advisor shares trusted ETF for the cannabis industry, right? So this is a cannabis stock ETF. So there's two different ways that you can enter a covered call and how covered calls work, right? So if you come to the different strategies over here, you'll find one at the bottom called covered stock. Covered stock is a covered call. It enters the 100 shares and it enters the call option for you at the same time. So this stock is currently sitting at $4.85. So I want to do the $5 covered call. So what you see here is you buy 1,000 shares of the stock and you can sell 10 covered calls at the $5 price against it. So there's two different outcomes that you'll see here during this trade. One is the stock will go above $5. And at that point, you will keep the premium from your 10 sold contracts no matter what. But then you'll collect the 13 cents of intrinsic value as well. So from 487 to 5, that's 13 times 1,000 shares. I get an additional $130 as I cash out at the $5 mark. If the stock stays at the 480 range and doesn't go to 5, then I keep my 1,000 shares on the expiration date, and I'm able to then continuously sell a call option against those shares until it's exercised and until I get profits. There's many different ways that you can utilize covered calls. Like this one, if I saw was trying to go from 487 to $5, that's what I like to call a premium grab. What you're doing is you're using this as a trading strategy to make a nice piece of income without expectations of a super large gain, and it helps you protect against a nice loss as well. If I were to choose a different expiration on this, right? If I were to go 2 more weeks out and hit done here, now you'll see my average is down to 470. I'm getting about 17 bucks per contract. That's $170 that I can make against this stock. So this is a good way that you can enter a covered stock or a premium grab. Another way is to simply just buy the shares. If you wanted to just remove this portion here and get rid of the options part, you could buy 1,000 shares. Let's just say I think this stock is going to run to $6. So I would buy 1,000 shares individually. Then when it gets to $6, I can begin selling the $6 covered call as an exit strategy to create more income. So this is what it would look like here on this. So if I click covered stock, buy, let's just go to 1, and you can see from here. So we go to buy, the cost of the trade is $470. That's because it's $487 for the underlying stock, but it's 17 bucks deducted because that's how much my options contract cost. So I'm going to sell my one contract. We'll hit review. So you can see here, it says buy 100 shares of MSOS and sell one call contract against it. I hit send. It is not filled yet. This is what it would look like, just like that. You would see your 100 shares of MSOS, and you would see the $5 call option for September 8th that I sold against it. And I can continuously do this for as long as I want. It either goes above 5 and I get paid for the 13 cents of intrinsic value and the covered call premium, or it stays below 5 and then I get to sell another covered call against it, systematically lowering my average, holding on to the cash and being able to reinvest, being able to hold more cash, being able to stack up and buy 100 more shares, whatever you please. Start small, start consistent, and move on from there. For me to enter a covered call, I look for two things. One, I'm going for two different styles of covered call that Big Daddy Max likes to use. One, I call the premium grab. And the premium grab means that you're not looking for any intrinsic value. You're looking to sell a call that will produce income through the premium and premium only. One of the examples that I posted earlier in my group was a Mara $10 covered call while Mara's stock price was at $10.45. It was an in-the-money covered call, but the covered call in the money was producing 40 cents more than the extrinsic value. So if we bought 1,000 shares of Mara and sold one in-the-money covered call for 10 contracts, it was $430 guaranteed. If it goes below that, then you keep the 430 and you're still covered yourself with massive downside protection. That's one of the best ways I like to use covered calls. I call that the premium grab. And then the second one, you have to weigh the ROI, the technical analysis, and the upside potential of the stock. This is your classic, I buy Mara at 10 bucks. I want to sell a $12 covered call every week or two and collect 5 bucks of premium, but I'm looking for that $2 of intrinsic value gain. Intrinsic value gain will always be more than premium. It's just a little bit more risky when it comes to having minimal to no downside protection. There's only one thing to watch out for. I'll say two. There's two things to watch out for. Practically speaking, you go to sell a covered call. Let's keep the example the same. Mara, right? You buy your Mara shares at 10 bucks, $1,000 to buy 100 shares. It has to be in increments of 100. Then Mara falls to $6. Now you're 40% down. You're in the hole. Like, this is the greatest concern for a option seller who's using the covered call strategy. But at this point, you would have to get creative by lowering your cost basis while tracking your blended cost basis, and all in time, you'll be able to catch up or the stock will rebound. But the biggest concern is when a stock falls dramatically and you are trying to keep up with premium by selling lower than your cost basis premium. This is the biggest issue with selling covered calls. The stock drops. People say, oh my God, Max, I bought the stock at $10, but now I have to sell an $8 covered call. And what if it goes from 6 to 10 in a week and I get stuck? That's the biggest problem. The second biggest problem is people get married to the stock and they forget that every time you sell an option and you collect that premium, you drop it off that blended cost basis. So I always tell people at that point, take the 20% loss, sell it, collect the premium. That premium is forever going to be profit. Once you're able to make up that $2 in premium or ride the stock back to $8 to $10 at that point, you're back in the green and you're back in a better position than you were. Repositioning, selling, buying back in, selling, buying back in. Remember, stocks can go to zero, but I guarantee you your premium will beat the stock to zero. I think you will be able to outrace the stock, any good underlying company, to zero by selling options consistently and never being married to the stock. Let's take a look here. I know you're thinking, Max, what the fuck did you just say? Like, I'm lost in the sauce. No problem. Let me clarify it for you a little bit more deep. So if you take a look at Labu here, you'll notice that I'm red on the day. The stock is down and my trade price is $4.95, but my shares of Labu, my 3,500 shares of Labu are very flat, right? All of my calls and puts are red at the time. So what I mean by that is take a look at my PL year to date. I'm up $16,000, $16,900, almost $17,000. So if I were to take my 3,500 shares times 5, right? That would be what? 15,000 times 18,000. I don't know. Someone do the math for me. I don't know what the math is. But now let's subtract all the premium that I've made this year on Labu. Then divide that by my 3,500 shares and tell me how much my shares are really worth. So hold on, let's get a calculator. Let's do this. Let's bust this down. So I have 3,500 shares at $4.95 each. 17,325. Now let's subtract 16,980. $345 is the actual equity I have left to pay off on my real estate mortgage here until all 3,500 of those shares are free cash producing assets forever. This took me like 8 to 10 months. I don't remember the exact time. So now let's see how much those shares are worth. 345. Now divide that by my 3,500 shares. And what's my cost basis? 9 pennies per share is what I'm down to. 9 fucking pennies. Once those 9 pennies are paid off, I have a free cash producing asset forever. That is the power of the wheel. That is the power of Labu, that baby. That is the power of keeping track of your year to date and your blended cost basis versus your overall dollar cost average. So this is probably a great visual for everyone. So in a few weeks, they're going to go, damn, Big Daddy Max is actually sitting here making real passive income. Real passive income. I just showed you. I mean, that's the cheat code, right? Like, there's, besides real estate, there's no other option. I mean, obviously there's your standard hedging techniques, getting advanced option strategies, mitigating risk. In multiple ways you can do this, right? I'm not saying that this is the only way, but it's a way, and it's a way that Big Daddy Max has lived off of and sustained for 3.5 years now. So I think it is just the cream of the crop way. I think it's the most boring, most consistent way. In and out, hitting premium pops all day long. And there is some times where I might take a $2,000 loss just because I know in the long run, I'm going to make that $2,000 back and then make $3,000 or $4,000 on top of it. Then I might take another $2,000 loss. That's the whole point of not being married to the stock. But as I just showed, I think that this is true passive income. Even with real estate, there's a tenant who could break your balls or break your house. Even in the stock market, you could take significant losses. But if this thing drops to $1, I still don't give a shit because I could sell the $1 covered call on it and buy right back in at any price because it's paid off. That's the power of real estate and paying down your real estate mortgage. Covered calls are one piece the larger piece of the real estate program, right? Because covered calls means you already own the underlying stock. You're in for a certain dollar cost average. And it's our job now to pay off that real estate mortgage of the underlying stock as quickly as possible. And that's what it means with the real estate. And that's how it's referenced with the covered call side, because the covered call side is the more important side because you already own the stock. The Greeks are never good for an options buyer. They're just trash. Unless you're a Delta trader and you're buying $70 in the money, like options buying sucks. Options selling, first off, we got Big Daddy Theta, BDT, my right hand man, my fucking dog. He is working for me 24 hours a day, crushing that buyer's premium for me. Secondly, we have Delta. Selling options with a low delta, a 20 delta or lower, give me an 80% chance of success of just collecting that premium. Let's talk about implied volatility, which is measured through Vega, which is added to the options premium. Inflated premiums mean that I get to sell that option at inflated prices. Buying options, you're buying the inflated prices. Why the fuck would someone go buy an apple for $1 one day and then buy the same apple the next day for $3.25? You wouldn't. You'd be like, oh, hell no, I ain't paying that. But options buyers love that shit. So there's multiple factors of how the Greeks are so beneficial to option sellers. So first, I'm going to open up the Labu options chain here. All right. First thing I'm going to do is look up the Labu options chain. I'm going to do it separately this time. So I'm just going to buy the shares. Right. So this is the Labu options chain right here. So I don't actually need this. I'm just going to come up here and I'm going to buy 100 shares of Labu right now for $500. So this is it. 501 review, buying 100 shares of Labu right here. Send it. There we go. I have just purchased 100 shares of Labu. So now I can come to the options chain with that 100 shares that I just bought. And now what I'm going to do is I'm going to come to the weekly. I'm going to go to the $5 call and I'm going to sell one $5 call. As you can see here, you see how it says -1. That means I'm selling. You can see here, buy, sell, buy, sell. We want to sell one $5 call now. This is what I would consider to be that premium grab. So we're going to sell it for $11 of value. $11 may not seem a lot to you, but now that $500 is worth $589. I've knocked 11 cents off of my real estate mortgage. If it closes above $5 now, then you can have my shares and I can keep that $11. So it's a fair transaction. But if it closes below $5 on Friday, then you just paid for a contract that's worthless. So I keep the contract money that you had to pay me and I keep my shares. But then maybe next month you say, hey, I really want to try that deal again. Well, guess what? I could sell that same contract to you if you want, and you could do it over and over and over. So right now I'm going to review, send, and I just sold another $5 covered call on Labu. So if you go back to my overview, my positions, and you look at Labu here, you're going to see right here, September 1st, $5 call worth 11 cents right there. And that means that I just bought another 100 shares. And if you look down, you'll notice I have a staggered wheel going with covered calls and cash secured puts simultaneously every week, bringing in a little bit of extra paychecks. Oh, yeah. Oh, yeah, no, there's people that do that, literally. There's people that search for the one in the money that has a quarter or higher of premium over the extrinsic value loss. And what I mean by that is if the stock is $5 and the 450 call is paying $75, that means you're covered for that 50 cent loss and can still make 25 cents on it from the premium that costs more than the extrinsic loss. So if you find those, there's people that sell in the money covered calls with, if you had 100 grand, you could do 20K a day. If literally that play I just did, if you would have done 20K of it, right, you would have been able to buy, what is that, 2,000 shares? no, excuse me, 4,000 shares, and then you multiply that 11 by 40, congratulations, you just did a $440 premium grab for 20 grand. Now, what if I did that every single day of the week? 2,000, 3,000 in passive income. You can diversify, choose multiple stocks. And what you're doing is creating an environment of strong downside protection. But you have to remember that it's a premium grab. And if the stock goes up to 10, you're going to be pissed because you're like, oh, I could have sold it at 10, but now I have to sell it for fucking 5. That's the part that's hard for people. That's the part that gets people caught up, and then they get stuck in rolling options and creating and digging a grave for themselves. That's the part that's hard. The intention of the trade is to be a premium grab. So you know right when that option filled, I am so happy right now. I just made the premium that I wanted. That's it. It's true. It's true. The intent, it goes back to the intention of a trade. And this just eclipses all options trading, which is dumb high risk. And that's why intention is so important, right? If you're intending to scalp a trade, don't stay in it all day thinking it's going to get better or it's going to get worse. I'm going to make more. That greed, that fear, that's what it is. If the intention of a trade is a swing trade, don't cut it in 30 minutes because it's down 10%. Like, intentions are important and you must follow through with the intentions. Covered call intentions, if you were to enter with a premium grab, is to simply sell the stock on the expiration date and keep the premium. That's the whole point. If you go to sell a covered call and you do the intrinsic value type of play, then yes, now you have the opportunity to make intrinsic value. We buy in at 5, we want to sell at 550, and that's the goal. And we sit here and we wait until we sell at 550, which could take weeks and weeks and weeks. You just don't have the downside protection like a premium grab does. And I always recommend for new option sellers who want to get into covered calls, find those one in the money premium grab opportunities and protect yourself with massive downside protection over the intrinsic value gains, over the fact that a stock might plummet on you. This protects you, and this will start generating income, and you'll see the system slowly working as you start building your real estate. Downside protection. So the term downside protection, right? Selling an in the money covered call. If you bought 500 shares of Labu or 100 shares of Labu at $5 like I just did, and you sell a 50 cents in the money covered call. Let's just say that 450 covered call is worth $60. So that means if the stock falls to 450 or lower, that means I keep the shares and I get to keep the premium. But the premium was $60. So now that the stock is at 440, my blended cost basis is 450 minus 60. So I'm already down to 390. So I've already protected myself all the way down to 390. So if the stock falls from 5 to 390, you're at break even technically. And that is the downside protection piece that's so important. Now, if you were to hit that, you're still fine. Now you can consistently sell the 450 covered call over and over and over and over again until it bounces back up, and you'll accumulate a nice sized gain while you were in the money the whole time. If you were to do this with an intrinsic value, it would not work that way. That's the downside protection. So if you sell the premium is used as protection. The selling options is like the slow, it's like the financial planner who gives you 2% a year and you're like, yay, like that's the selling options is boring, and buying options is like literally like going into the world's greatest casino. Like, yes, you can get yourself a statistical edge. There is traders that are out there that are like wildly successful. So there is an edge, like people say poker is gambling, but how the fuck does Phil Hellmuth have 20 bracelets? 21 tournaments, right? Like, that can't be a coincidence. There's got to be a statistical edge. Same thing with the market with buying. So you can buy options and it's just the world's greatest casino. I can't promise you selling options is going to make you rich quickly at all. I can't promise that you're going to 10x your money in a week like buying options at all. But I can promise you that you'll be able to consistently grow it like a high risk dividend portfolio over time. And you'll be able to start making paychecks in a few years off of it, and maybe inevitably retire, or even maybe the fire method. So there's a ton you could do there. But buying options is exciting. It's fast. Like I said, it's that redhead in the car that's fucking flashing her big tits at you, and we're sitting here in our minivan with our two kids in the back. Like, it is what it is. Passive income should be everyone's fucking goal. Multiple streams of income, all the BetterHelp books, Rich Dad, Poor Dad, all the books that we recommend, passive income is it. Real income stream is cool. Turning that one income stream into two, into three, and then not having to worry about any of them, and they pay you over time, like sending your fucking army of money out there and they just capture other armies and bring it all back. Like, that's the goal, right? Doesn't everyone want financial freedom? Doesn't everyone want time freedom? Like, finance freedom creates time freedom. Time is the one equity, unfortunately, that we can't get back, that we lose forever. It is an inevitable ticking clock. So if this one is promoting that, I mean, isn't that the goal? Like, we have one shot on this fucking shitty spinning rock. And if I have to get this financial piece down to enjoy my one-time piece, that's, for me, everything. No, hell no. I used to be a full-blown degenerate buying options weeklies, but I did it at the end of the Donald Trump bull market, so it wasn't really fair back then. I used to open up Tesla like 2-month leaps and make $100,000, and you used to buy any stock for a week, 10 grand, 20 grand in, and I'd pull out $8,000 a day. I mean, it wasn't the same breed of market. Things literally only went up. So a different breed. So it was only during COVID that I started selling options, when I started realizing massive losses. Then I was losing 8, 20, 30,000. I lost $136,000 in one day, and then the next day 22 more. And I was like, holy fuck, like, I just accumulated all this money and now I'm losing it. And I was like, Big Daddy Max, we got to make a fucking change. And then I stopped trading for a few months, and then I got clarity on selling options. And like me being me, I dove in head first. I need everything and anything. I need to know it all about options selling. Then I need to paper trade it, practical use, and jump right in. And now 3.5 years later, here I am, full-time option seller. And that's how I've made all of my income for 3.5 years. I mean, I think the two biggest reasons why somebody doesn't do covered calls, honestly, is one, they think they need $100,000, like the example that we gave, right? Like, you don't need $100,000. You could start with $5,000. If you start with $5,000 and you bought 10 or 1,000 shares of Labu right now and sold the $5 call, that's $110 a week. That's passive income. Like, there you go. So you don't need, and if you do that for 5 weeks, now you can do 11 contracts. And then if you do that for 5 more weeks, now you're at 12 contracts. And then you're down to 4 weeks. And then you're at 13, 14. Then you go to you scale over time. And that, you could start slow and small. And secondly, it's boring as shit and it's not exciting. And not a lot of people are like me, are trying to push options selling out into the world, right? Everyone's like, buy. Look at me. I made 600%, 300%, 20. That's what I told you. You know what I mean? I'm over here eating at the fucking matinee 4 p.m. old lady diner where they're giving out chicken liver and shit. And you're over here with this big tit redhead who's like, come on over, baby. I want to sit on your lap. You know what I mean? So like, it's very hard to make the choice, but eventually the redhead's going to rob you, steal all your money and steal your heart. And you're going to come crawling your slow bitch ass over to the diner. Max options trading is the best place to come learn covered calls, because I am probably the only server owner who sells options full time. I think we have a very unique approach and a 24-hour beginner help channel that we can curate to you in your small portfolio. It's simple as that. If you want to sell options, my YouTube has more options selling gold mines than anyone's. If you want to sell options, my team is here to support you in any way possible. And we don't give a shit if you only come for a month or two. Take the knowledge and go off on your own. That's the goal. So you come over to Max Options Trading. There's one thing that I can promise you, is that you're going to learn more about selling options than you've ever thought in your life. Covered calls, is the fucking shit. I mean, if you don't want to listen to my fat fucking dumbass talk about it, look at the screen I just showed you. $17,000 year to date, and I only have 9 pennies to pay off. Like, don't listen to me. Listen to the proof.